Good afternoon, everyone. Thank you for joining us. I'm Patricia Alba, Assistant Director of Communications and Work Life. And for today's webinar, we have Lisa Leslie, UF IFAS Extension Agent at Hillsborough County, and she's going to talk to us about how to prepare ourselves for a successful retirement. Please make sure that your microphones are muted so we avoid interruptions. We are recording this webinar and it will be uploaded on YouTube. And finally, if you have any questions, please post them in the chat and we'll be addressing them as we go through the presentation. So with that said, Leslie, please, Lisa, sorry, please go ahead.
That's two first names. So, all right. Hi, everyone. We saw that there's a lot in the chat of a lot of variety of retirement dates. So we'll go ahead and start. We're going to talk about four key considerations for successful retirement. And think Patricia mentioned this, but I am based in Hillsborough County with the Extension Service. I have a certified financial planner and accredited financial counselor credentials. Those credentials I don't operate in the private sector, but those are just to help me hopefully be a better educator. Okay, this webinar is going to provide general personal financial information. It's not going to address all the variables that apply to somebody's specific situation. So we're going to talk generally. Questions are welcome, but remember, this isn't a one-on-one. It's a group event. I do my best to provide accurate information. Sometimes I make mistakes. If I make a mistake during this webinar, please call me out. I'd really rather have you call me out. We correct that and we can move on. If I find out later I made a mistake, I'll send out some corrected information. And do keep in mind, this is education. It's not investment advice. It's not going to take into your unique situation. If you want more, just, call or email. I'm happy to chat. All right, and questions and comments are welcome as we go through. Let's make this a discussion. Um, put in your comments, put in your question. Oh, hey, I see Josie there. She teaches similar things as I do. Everyone, let's learn from each other. All right. The considerations we're going to explore, whoops, getting ahead of ourselves, are um, e- four considerations. Explore your situation, asset allocation, understanding our human behavior, and financial services. So those are four key considerations. The biggest, most important thing, the big important thing is asset allocation. In ensuring success for retirement, asset allocation can be really important. And it took me a long time to realize what that meant. I talked to financial planners and say, oh, yeah, it's important. But I really realize now it is really important. All right. So we're going to start with exploring. So we're going to start with the first one, exploring your situation, thinking about your situation. It was great that Patricia read off, what is your target date for retirement? Is it really soon, 1 to 5 years? Is it in the middle, 11 to 20, or is it greater than 30 years, a long time from now? Because the reason is that your priorities are going to be a bit different. And I can say this, I am less than 5. Hopefully, I am 3. So I am really close. And I can tell you this from going through the life cycle, the things you think about early when you are way, way far from retirement are very different. Priorities are very different when you are a long time off. The big thing, don't overthink it. The big thing, if you've got 30 years, 20 years, just regular, steady investing, your priorities and lifestyle are likely to change. When I have coworkers who have 30 years from now, 40 years, it's so hard to say what will my expenses be in retirement. You really can't say, okay, this is how much I'm going to need in retirement. Just regular steady investing, and think about your priorities as you get closer. Again, regular steady investing, building appreciating assets and reasonable debt levels. In other words, building things like, retirement funds, investment funds, and building, lowering debt, get rid of credit card debt if possible, lower down any expensive debt, increase equity in things like home or property. Um, Close to retirement, what are my assets and liabilities? As you're closing in, you really start taking a hard look at What are my assets? What are my liabilities? And what do I and now, I mean, I can tell you, I can start really picturing my lifestyle in retirement, and I kind of am getting a real fix on what my expenses will be at the first day of retirement and through my retirement years. And somebody asked a question about how are sick days handled. Um, how are sick days handled? That question is best answered to HR. That's a good question because sick days can be an asset. I know with my employer, I am going to have a bunch of days, hopefully. Hopefully, if all goes well, I will have a certain amount of days. And I am going to think about, do I want to cash these out or do I want to stay on and use them as vacation time to pay for? So my insurance is still covered through my employer at the regular employee rate. I'm also going to think about, depending on how big it is, do I want to wait and cash it out in December when it'll get lumped in with all my other income? Or do I want to work a couple months into the new year when my taxes will likely be lower because my taxable income will be lower? How are sick days handled exactly through UF, though? How do they pay out? That would be a great question for HR. All right, thanks for the question. All right. So again, explore for everyone, explore our living expenses. It's not bad to know, get kind of a fix on how much it costs us to live. How much it's going to cost you, though, if you're 3 years away or a little away, you kind of really starting to picture it and picture what expenses will go into retirement, what'll change. But if you're farther away, just make sure what you're spending money on is in making you happy today, and you're not regretting it the week after. Oh gosh, but keep an eye on it. An emergencies fund is very important. It's our cushion. And we're going to talk a little more because that goes to asset allocation. How much I need for emergencies is going to be very different when I have 30 years versus or a cushion. What cushion do I need when I'm close by? Keep an eye on the value of our assets and debts. And again, what is important to me today and tomorrow? And that was something I applaud the folks who are saying, what happens, they're far away and they're preparing. Good for you. I'll be honest, I didn't start preparing until I started teaching this stuff. All right. So retirement assets. When we think about our retirement assets, we have things like pensions. That was the the old-fashioned type of thing was you worked at a place for a long time and you might have a workplace pension. I know still with FRS, a lot of us still have chosen the pension plan. um, Explore your workplace retirement plans in the pension. Decide another type of pension is as Social Security. And again, when I think of a pension, that's a certain amount of income. There's a certainty to how much I will receive, and I'll receive it to till I go. Till I pass away, and perhaps if I have a spouse or someone, it may continue even if I'm gone for them. And there's certain value to that type of guaranteed asset. Whether it's the one, pension or investment plan, that's a decision to make. And I think you get a one-time choice to change that. And then investment assets. So again, a lot of us like to have as many types of assets as we can. So having just a pension, having a pension, have Social Security, have investment assets. That's a cool thing to have a lot of different little buckets. Years away, just explore. Um, Explore your thing. And somebody asked, I confess I've defined that's a pension, right? Yep, a defined benefit. Good comment there, because a defined benefit. It's exactly what it says. With a pension, you kind of know based on years of service, based on percentage of salary, they've defined what you're going to get. A defined contribution plan are things like 457 plans. Those are, you define the contribution. What you end up with retirement depends on a lot of factors. So good point there. If I'm years away, I just want to know my plans. It kind of, I'm glad HR offers these things and a lot of variety, because a lot of folks don't even know. I'll ask, are you in the investment plan, the pension plan? And they don't know. If you're years away, it wouldn't hurt to just know that. And years away, start automating investing for retirement. As you get closer to retirement, you can really start looking at the numbers. I look at my workplace pension numbers. I look at my social security. If you're 30 years away, it's a long time. Get an idea of it, how it accumulates, how it works, but don't fixate. And I used to wonder because one of my coworkers, he doesn't he said, I don't talk about Social Security. And I thought, how could you not? But then I didn't realize he's talking to people with 40 years away. Nope. Don't, it's just know it's there. It will very likely, it would be drastic if it was ever to go away. Understand we're all paying into it. We pay 6.2% of our income, and our employer pays 6.2% into it. So it is there, and it's there. But if I'm 40 years away, 30 years away, I'm not going to run the numbers so much. But do know if a person does become disabled and they've been in the system, there are benefits if a person cannot work, if it's a serious type thing. Broken leg, no. Serious situation, yes. All right, dollar cost averaging is your friend. Has anyone ever heard of dollar cost averaging? Anybody heard any good things about it? Dollar cost averaging? Okay, you've heard? Anybody heard? Um, no. Okay, so okay. All right, well, and if you've heard anything, put in the chat, any comments you had. And again, this is one of those things I learned about academically, and now I fully understand the value of it. It took me a while. So what that means is we designate a certain amount of money, and we say if we're going to say $200 a month to invest, it averages out how much we're going to pay. And I didn't run the averages here, but the thing is this: you're always going to invest $200 a month. And when the fund prices, if I'm buying shares of an ETF or a mutual fund or a stock, or that would be a stock price or whatever, I am going to get less when the price is high. So you see here in January, $200, price is $50. I am going to get 4 shares. Um, and I really should have done, I didn't do the averages, but the principle is this. So when the fund price is lower, as you see $40, I'll only get 5 shares. If it's in April, you see it went way down, then I get 10 shares. And the idea is this: it can help you in two ways. The average price you're going to pay is going to be much lower than the highest price. It is going to keep you on a plan, and people say, "Oh no, things are down. I don't want to buy." If you are many years from retirement, you have the potential here to get a lot of things. Um, if those 10 shares that cost low and they go back up, you can have a lot of growth. It can help you take a lot of the emotions out of it. So and I did again, you just pick an amount, how much you pay for the fund. The average is probably going to be lower than the highest price, and you're going to end up accumulating a lot of shares over the long haul and take the drama out of the investing. And a lot of people, they think, "Oh no, my shares are down." But guess what? If you got 30 years and you've got a lot of shares, chances are you're going to have a lot of shares when you're need to cash in, and those are going to increase in value typically over the long haul. We don't know for certain, but typically they do increase. All right. So I just want to talk a minute about tax advantage products. When you think of tax advantage products, what do you think? Any thoughts? I know everybody, few people I know get all happy about talking about taxes. I'm one of them, but let's quickly. Um, if you're saving for long-term pre-tax, okay, pre-tax Roth, IRAs, yes, okay, cool. Tax-free payout, after tax deduction, great. All things, yes, pre-tax and post-tax. So, yep, all right, and that's the thing. So we did, if I'm saving for retirement, or really any goal, that's 10 years or so away, I really want to use tax advantage products. And what you all said, pre-tax, post-tax, know which is with and which one is best. It's your situation. The different types of tax advantages are tax sheltered, where growth is not taxed. Tax deductible, as someone said, pre-tax, post-tax. So tax deductible means it comes out pre-tax. I can give to a 403b, a 457, a 401k. If it comes out pre-tax, in a traditional type retirement plan or an IRA, I take a tax deduction in the year contributed, um, and then I pay as I take the money out. In tax free, somebody said pre-tax, post-tax, that would be your Roth plans. Doesn't reduce my tax in the year I contribute, but it can grow, and if hopefully it'll grow and grow, and then when I take it out, there's no tax on the growth. Um, the advantage received depends on the vehicle and the rules. And I have another slide here that's going to kind of say a little more about it, and also include investment capital gains. In other words, if I own a stock, a mutual fund, an exchange traded fund, um, and it's not giving out dividends, if it's just, I'm looking for value increase, it's a type of fund where you're not giving dividends. ETFs, exchange traded funds, um, are extremely tax efficient. Or if I held, stocks while they're until I cash out, um, and hopefully they go up in value. If I go up in value and I realize a profit and I sell it, then I have a tax event. If I don't, um, then then I'm not taxed on it. I can determine the tax timing of that vehicle. In the olden days, we'd always say, the commissions have really come down on ETFs. You can get very low price bundle of investments for very low price, and they're very tax efficient. Um, Long-term gap claims. Now that if I don't sell it, if I sell something and I hold it for a year and a day, they get um, a favorable tax rate, 0%, 50%, 15%, or 20%. And so there is positioning there. You want to think about that, when to cash out. And again, just realize though, if I hold something and it is growing, I don't that gain is not realized. And of course, if I have a loss, I'm not realizing a loss unless I sell it. Maybe it'll come back. A decision. Okay. And I see. Thanks, Patricia. I see you putting some articles in there. Just holler if I need to look at the chat. All right, now retirement accounts, gains are tax sheltered. Well, I have this wonderful blanket over my retirement funds. I don't have to pay any taxes. So that allows a lot of growth. Hopefully, growth, there can be losses. Believe me, I've just had some big losses. I'm not planning on pulling that money out, even though I'm going to retire in 3 years. But you can have gains or losses. But the cool thing tax wise is that the gains are tax sheltered. In a Roth account, as someone said, some people say they're tax exempt because you didn't get a tax deduction, and then when you pull it out, you don't have to pay any taxes. And hopefully that could mean, especially for somebody who is early career, a whole bunch of gains that won't be taxed following the current tax policy. Now, do know the rules. The advantages here is, yay, we get all these tax advantages, and typically that's where you have a little less flexibility. With retirement accounts, there are rules, and if you break the rules or take out money early, there can be penalties for early withdrawals and unexpected tax increases. So understand those. There's different rules. There's in regards to IRAs, individual retirement accounts, individual and Roth and traditional. So do know those are rules. Um, Now, with savings accounts, those are not advantageous. Taxes every year, and that's why I can't, because of inflation. I can't just. I'd love to just put my money in a savings account. I know it'd be safe, but I'll pay taxes on the interest every year, and it's not going to keep pace with inflation. That's why investment products, either just an investment um, or a retirement account, are really tax advantage. All right, so closer to retirement, as you're getting closer, again, you explore what types of assets you have. We talked about what kind of tax advantage am I getting. Understand the rules before pulling money out. There is a new thing that came along where you can take $1,000 out for an emergency. And Roth plans, you can take out your contributions without penalty. But if you start tapping the earnings, then there's taxes and penalties. So just know those rules. Closer to retirement, think about, this goes back to what we talk about, what type of assets. You can start thinking about how much of my lifestyle can be covered by fixed income sources. And this is for folks who are closing in on 5 or years less. Doesn't hurt if I'm 10 or years to take a look and say how much Social Security can get an estimation. We should all want an account on SSA.gov. Um, so and see how much is going to likely be covered by some fixed income sources. Again, this is real, you're getting close, and how much will come from other type assets. I see a question: what percentage do you recommend someone who's 30 years away from contributing to a post-tax account? It just depends. It really depends. I really can't give investment advice. There's general rules of thumb that say put away 10 to 15%. Um, but that's general. If you're 30 years away, you've got a good bit of time. Um, and again, the general rule of thumb works for some, but not all. You have to take a look at, what are my debt levels? Do I have expensive debt? Maybe I want to work on that too and put a little less away than the 10 to 15%. Um, do I have a cushion? Do I have a nice emergency fund, 3 to 6 months of at least non-essential expenses? And it depends on my situation, how much emergency fund I want. Do I have sick time? What's my situation? So a ballpark figure for somebody who's far away from retirement, there's always, um, yeah, post-tax accounts. Now, post-tax, you're talking about Roth, and I think UF offers Roth retirement plans. Like, do you guys, Patricia, you guys have Roth 457s or things like that as well as
We have
traditional?
457B. And earlier I put in a link to the article that talks about the 403B and the 457B, with the UF specific ones, right? And how you can, whether you qualify for that and how you can kind of go about setting that up for yourself as well.
Okay, cool, cool. Thank you for doing that. So take a look at that information, and there are caps. It's pretty darn high. Well, and if you're making it and that's the difference between an individual retirement account, a Roth IRA, and a workplace type plan. Your caps on your workplace plan are going to be higher. I have lost track, over 18, 20. It's a lot, 17, 18,000. And hats off if you are able to put in that much. And then for IRAs, and I'd have to look up, because, and it's old, if you're 50 or above, I think it's 50, 55, 50. It's you, there's more. You can put in more there are catch-up contributions. And I always get it confused with health savings accounts. One's 50, one's 55. Um, but there are limits. For the in the workplace plans, the limits are much higher than, I think, 7,000-ish for an individual retirement account per year, and it is up to your taxable income. If you have no taxable income, you can't contribute. Now that's either you or a spouse, and there are some limits. But retirement plans in the workplace it's pretty high, and then you can do an IRA, Roth, and there are limits on that as well if you're a high earner. So if you need that info. Now, do know there are limits, and that's a good point, because if somebody over contributes, particularly to an individual retirement account, they want to get that money out before the tax filing deadline, or they'll face penalties on overdoing it. And how could that happen? I, it can happen if you have accounts in two different places. Like, let's say you have an account with Fidelity and an account with Schwab. You have an IRA. Each one of them is going to say, "Hey, they'll know your age, and they'll say, "Hey, you haven't contributed the maximum." Well, maybe they don't know about your total situation. Thanks for putting that in the chat, Teresa. All right, so very close to retirement, take a look at things like health insurance, any employer provided retiree insurance, Medicare, and start thinking about a Social Security claiming strategy. Gets a little more if there's two folks, and there's a lot. We've done whole webinars on just choosing when to claim Social Security. So again, this is for folks who are closing in 7 or less years, maybe even 10. Take a look. I think FRS, people under FRS, their employers provide a retiree health insurance. I envy you folks. You have a better deal than I get here in the county. But do keep an eye on these things. It's time once you're 10 or less, 7 or less, and then as you're closing in 3 or less, it's really time to start thinking about this stuff. All right. So asset allocation. This is really, like I said, it's really important. I didn't used to understand, but it's really, and it's what is appropriate for your situation. Um, because the idea is that you want to balance growth, hope for growth. I mean, we're seeing things are going down. They do tend to come back, but we do, and a growth and risk. Because they're with growth, with things that have a tendency to grow, like companies, stocks, investing in companies. There's growth companies, they may go up or they may not. That's where diversification can help us a bit, not just holding one stock. That's where mutual funds, exchange traded funds, wonderful because we get a bundle. Uh, we do want to think about preservation of some money. We need, if we don't want to lose all of it, we don't want to have to tap things and pull money out when things are down. Sometimes we may, there are reasons to do that, but we do want to have some where, hey, it's not growing all that much, but you know what? I've got some money that's going. We want to think about risk. We want to have, again, that cash, the liquid stuff, emergency fund if I'm far away again, or close, think about it. And it does depend on your situation and how much risk can we tolerate? How much, there is the sleep at night factor, but we do know if we stick money in a savings account, okay, the principal is going to be preserved, but it's really the purchasing power is going to be gone. So there's the inflation risk is very real. All right. So generally speaking, many years from retirement, growth is important. We can be more thinking about we want to grow it. I've got 30 years. I want growth to keep pace with inflation, to be maybe even beat inflation, hopefully, to be tax efficient. There's many years to recover from market downturns. Right now, there's buying opportunities. If your early years things are less expensive, you can accumulate quite a bunch for not so much. And there's lots of years to recover, to build up some, cash type things or things that are more stable. As we get closer to retirement, it's very important to kind of have that cushion, to have some capital that's not going to go away. And it's crazy important because when we're accumulating, we want to accumulate. That's important. And I missed out because, again, before I started teaching this stuff, I was so risk averse. I put things away, didn't get all the growth I could have, eh, did, and until I learned more about why growth is so important and the inflation risk. Closer to retirement, we really want to have money that we have safe and available to cover things for probably several years in different safer baskets. Because as we get closer to return, has anybody ever heard the term sequence of return risk? Um, Sequence of return risk is where if I'm close, if things are down and I have to pull down things out, when my retirement, when I'm real close, when I'm in retirement. Now this is in retirement. I pull things out, things are down in my first 10 years or whatever, 5 years, and I pull things out. It's gonna hurt uh, my whole overall thing. Conversely, if I'm in retirement, I have 10 good years, things are great, and then later on things go down and I have to pull things out. It can cause much less pain, much less loss to my portfolio, and I will be probably be okay. And these are the kind of things to think about with an advisor. How can I mitigate for sequence of return risk? What kinds of secure stuff do I have as I am in about to retire? Or not really before. 3 years, 5 years before, start thinking about this. All right, so here are some very, very general examples. Yeah, sequence of return risk. That's a thing to think about. Some of the sites, the investment sites, will have information about that, about how to mitigate that for that, to make sure you have the cushion, that your mix of assets you have some cushioning. The other thing to think about is secured income. If you have enough secured income from Social Security, from pensions, that can really be a nice cushion as well, and not having to tap things in early retirement when they're down. Now, this just shows some very general examples and my very primitive skills of putting together little pie charts. But the idea is to just kind of very generally, stocks are considered, um, in growth companies, more risky, but more potential for growth. So if you had a lot of stocks and just a little bit of cash, it'd be considered very aggressive. And understand that things will go down. A lot of us have had gut checks through the years. I have was around and investing in 2000, what was it, 2007, 2008, Great Recession. Oh, things went down, 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 but eventually they came back up. But that's a lot to see there and watch money, your assets, your net worth goes down. We saw that again during COVID. Thankfully, it was really quick. Things went really down and then they came back. But understand that that will happen. That's why that emergency fund, the cushion, the understanding this can be really important. And then another portfolio shows a moderate risk, more less in stocks, more in bonds, more in cash, and then so the different portfolios there are just very examples of a very general way to think about it. Um, okay. All right. And I see somebody has a comment, but maybe they're just helping someone else with it. And here's a diversification example because it goes beyond just stocks or bonds, cash. We want to think about big companies, small companies, sectors of the economy. Generally speaking, it's not a good idea to just be in one sector. We want to think about bonds, corporate bonds, treasury bonds, and even regions of the world. If we are seeing a changing world, um, you know, US stocks have done very good, but do we want to consider other regions of the world as well? And then some money market accounts, the types of things that will just be a cash cushion that won't grow much, but there's a real value to having a cash cushion. And again, this is just an example. This is the kind of thing, and there are a lot of tools on different websites, Fidelity, Schwab, maybe even I've never checked out the FRS investment plan, but there are a lot of tools to help you kind of maybe fine tune this, and then financial advisors can help fine tune this. All right. So we talked about taking a look at our situation, is important. Asset allocation is important. And again, so explore our situation. What's the where am I? Where am I today? Where do I want to be tomorrow? What's an asset allocation that's appropriate for my situation? And then let's talk a little bit about emotions, and personal finances. Um, do we always make decisions just based on logic? I think we all know we don't. We're human. Um, we want to know behavioral economics. Has anybody heard of behavioral economics? Economics. How many people have heard that term? Behavioral economics. Yes, Josie has. Yeah, and okay, so a lot of people have. And it used to it used to be a new thing, but it's the psychology in a person's financial decisions. Good. All right. So some people don't, but it's really important. And they even say because I listen to a lot of financial planners, I listen to a lot of their podcasts, and some of them even say that a lot of what they do is help people manage their emotions, and that may become more of the field as we get so many things, so much good software to help us balance the objective type stuff, this meeting. But just some biases and emotions. We have a lot of aversion to loss. There's been a lot of aversion. We don't want to lose money, and trust me, it can be like, oh my goodness, we don't want to lose. That there's been research to say we have a stronger emotion to a loss than a gain. That's why sometimes we may hang on to something longer than we need to, or we may panic. A lot of there's overconfidence. Oh, I can beat the market. And some people can, but they are the rare thing that can beat the market. The overwhelming knocked my socks off when I read some of the academic stuff. Market timing is very difficult. The general body of academic research will tell you, dollar cost averaging, diversification, and a proper asset allocation are much more likely to get you there than market timing. That's not to say no one can do it, but not most folks. Herding, market speculation. We see that. Oh, let's see, everybody's going after this hot thing. Let's go after this. And irrational exuberance. Anyone around when Alan Greenspan talked about irrational exuberance back in the before the Great Recession? That's where everybody is, wow, this big thing. Let's get this, and it can cause a real big, wow, wonderful big bubble, tech bubble that was wonderful. Everybody rushed in, and then the bubble can can um can can pop. All right. So some ideas to overcome our emotions to stay on track, and I welcome Josie or anyone who has some suggestions. Automate saving and investing, consider dollar cost averaging, think long term. Even though I am 3 years, hopefully 3 years away, one way or another, it's 3 years. But I am, and it hurts to see money drop. But I'm thinking long term. I'm not going to pull every dollar out when I retire. It's long term. Hopefully, I mean, I hope to live a while in retirement, and I hope my husband. I hope we are going to be there for a little while. So I am thinking more than, hey, I'm going to retire in 3 years and I'm going to grab it all out. I'm thinking long term as I'm getting closer, so I'm thinking long term. I'm thinking I'm not going to check my portfolio day to day. Although we always hear stuff on the news day to day, I'm not going to panic day to day. I'm trying to think long term. Um, all right. So we talked about the different things. We talked about looking at our situation, exploring it, taking a look at where we are as an important consideration, seriously giving our asset allocation a look, make sure we've got it appropriate for our situation, thinking about our behavior, and now financial services. So, financial services in the workplace, and I think it's great. Human resources is a great, and they're really proactive. Trust me, I've seen other human resources that have not nearly so proactive as UF. They've got a lot of helpful resources to help you plan and take advantage of that because UFHR is not going to sell you stuff to make a profit. They're just trying to help their employees. And then you have the Florida Retirement System. Again, they provide guidance and tools. I think they contract with Ernst and Young to provide unbiased information to people who are in the FRS system if they're in the pension, and they have lots of guidance, lots of tools. Take a look in there, take a look at your account, use their tools. They're not trying to sell you anything. And then there are private investment companies. They're offering plans, they do have guidance and tools and some very wonderful tools, but be aware they are private for-profit companies and that they're gonna, they want to sell things, and we all got it, we've all got to eat, we've all got to pay the bills. And it's great to have the different perspectives. I say, hey, start with the free stuff and then move on and get a wide variety of information. Um, okay. So some tools to say, and I can't see my slide. How much do I need? They've got tools. How much do I need? Now, again, if you're 40 years away, 30 years away, don't obsess. Just regular investing, low debt levels, reasonable debt, keep chugging along. If you want to figure, okay, I know a lot of fire, they want to retire in 20 years. Is that realistic for most people? A lot of those folks, they're retiring to go on to become influencers or something. They're retired, but they have a whole line of products. So I'm not, so for some folks, there may be a potential to retire early. It takes a lot. Maybe they have a lot. Be realistic about your situation. Bravo if you can do that. But understand, don't kick yourself. How much do I need? Be realistic about your situation. And if you're just like some of us who just work, don't have a lot of family money behind us, um, you know, come from modest backgrounds, it may take a while. Learn about different asset types. I briefly mentioned stocks, bonds, big companies, little companies. Just learn a little more. All those places can tell you. Learn about the different retirement vehicles. And it sounds like you all know a bit, IRAs and workplace plans. And as someone, said, hey, there's a limit to how much you can put in the different types. Very good. All right. So when you're choosing services, understand something because I've had this happen. Um, Understand, and and this is particularly for folks who are really close to retirement. I've had people say, "Oh, I this financial planner called and said I should cash all my, take and roll over my money into this." And I said, "Well, did they look at your income? Did they look at your living expenses, your assets, your liabilities, your anticipated pensions, including Social Security, your goals?" And if the answer to that question is no, then somebody's selling me a product. They're not giving me comprehensive financial advice. Anybody who says, "Hey, Lisa, have I got a product for you, an annuity guaranteed to make bunches of money or something?" Unless they take a holistic look at my situation, they're selling a product. Nothing wrong with that. I go to the shoe store, a local place to buy my running shoes, and they clued me into good running shoes. But they did not clue me into overall health, overall fitness. So understand when you're getting a product and when you're getting comprehensive financial planning. Uh, Good point, Constance. Thanks for putting that in the chat. Very important because as you get to retirement or even before, a lot of companies are going to start circling. Good comment. Compensation methods. Okay, so how do people, and again, everybody, I get a salary. So if I was making commission or hourly fee, my method of operation would probably be a lot different. In the olden days, most financial planners were like stockbrokers or insurance salesmen, and they made commissions. That model is still around. Particularly with folks who sell insurance products, nothing wrong with that, but understand they are selling a product and they likely earn a commission on it. In products other than insurance, and insurance includes, the typical property, health, and that sort of thing, because you do have the folks in the Medicare Advantage space that are making commissions. Um, Hopefully, I spelled that word correctly. I hope I did, but if I don't, and then the newer kind of model is assets under management. And this is where, for a lot of folks, early career, a lot of planners won't work with somebody who has less than maybe 250, 500, a million, a certain amount of assets because they charge a percentage of what they're managing. And that was kind of went from commissions to the standard, and that model is around a lot. Um, so if I'm just starting out, this likely no. And then there are hourly fee or annual fee. They're fee based. They'll say, hey, we'll work with you on an annual basis for so much money or an hourly fee. And I think I talked about this in another webinar where even a lot of planners will say who they specialize. Some people don't want to work with folks far, far away, and some people specialize in that area. Folks will even specialize or say, hey, I want to fire folks, financially independent, retire early, and they will, they want to help folks do that and charge maybe an hourly or annual fee. Just make sure they're giving you realistic advice. Um, but there's the different models. Understand how somebody gets paid and understand everybody has to get paid. If I work for a private for-profit company, I'm going to get evaluated a certain way and I'm going to get paid a certain way. Um, do a look. Broker Check is a great place, and I see we've gone over a bit over time here. This is where can we look up licenses? So this is a place you can look it up. It'll tell, even if they are not an advisor, this is a great place to see what licenses they hold, what companies they have worked for. So this is a wonderful place. Thanks for setting up the thing. But I would definitely, even if I saw somebody who's coming from Fidelity and going to be a speaker, or I watched a video, I'd look them up on here. What was their background? Another place I would look them up on the investor.gov, and I can, the SEC website, because that will, and you can put in, if you click the link there, and I won't do that, but you can click it, you can get even more detailed information. There's a form to look for, and I couldn't find it. I don't know if they took it down or not, but the form, so this site here, This one will give you information, background, complaints, licenses, experience, the whole shebang on that. But this form AD2A will talk about their fees, their business practices, their conflict of interest. I used to be able to find it on the SEC website. I couldn't, but I know some of financial planners will have it posted right on their website. So you might ask for this. I looked up one and I realized, oh my, I can't afford this person. But that's the way you can get down to how much do they cost, any conflicts of interest, things like that. All right. So we talked a lot about the different things. We talked about, hey, explore your situation, even just a part of it. Um, then we talked about asset allocation, really important for your situation, understanding our behavior, and then choosing financial uh, professionals. So take some steps. Take a look at your situation, understand your emotions. I view financial planning as something to reach my personal financial goals. I don't, I mean, I know I've shared a bit, maybe a bit more than I should about my personal situation, but I hope that helps motivate you. I hope I remember, back when my liabilities were far greater than my assets. Um, I hope it motivates you to get where you want to be, but it's not something I share. It's not to me, it's not a status symbol. My credit score is not a status symbol. My situation is mine, not to get where I want to go. If and don't if you lose money, if you gain money, understand your emotions. Understand, we do worry about our status. We tend to be risk adverse. I'd love to say I'm not, but we are. I am. We all are. And then explore the free financial services. I think I haven't been yes, good point, Stephanie. Yes, they are. I can I can tell you that. Yes, they do change. My values today and when I walked into this office many years ago are very different. What I value, my priorities, they change. Maybe not for everybody. Maybe that because I'm in a different place. But for a lot of us, well, change maybe a little bit. All right, so that's about it that I have. I think I went a little over, but I really appreciate there's lots of good, seems like a lot of good comments. I didn't pay attention to anything, but were there any other questions, Patricia, or does anybody have any questions now that we should take a look at?
I think the last one that I saw was how do you look up the licenses for financial planners? But you kind of you
Talked about that. Yeah, with this site is really good for that. Okay.
maybe can you touch on like fiduciaries?
Yeah, good point. So a fiduciary is someone who adheres to a fiduciary standard, has a legal obligation to put your interest ahead of theirs. So when they look at your financial situation, they have to make sure that they are acting in your best interest. And people who carry that fiduciary are registered investment advisors, certified financial planners are supposed to adhere to that. And if they violate that and sell you something that isn't in your best interest, then you have a legal case probably, to go after them. Um, and I recommend people seek out a fiduciary, but understand that eyes wide open, even if where you're looking at fiduciary. So use the tools, look them up, see if they have a fiduciary standard. I would recommend them, but understand that can, you know, that's a guarantee kind of sorta, but it depends on the profession.
Thank you.
Good to hear that, Stacy. Yeah, I mean, I know it it can be nerve-wracking, but I just think about the wonderful things. What am I running to? Good comments, Constance. Any other things, Patricia, you think we should talk about?
Don't see any more questions. I dropped in the
Yeah.
chat a link to our financial literacy webpage. And so if you want, here, I'll drop it one more time. So if you want to explore, like watch more webinars on like retirement, or you want more investing knowledge, then we have like a library of webinars that you can explore on that page. Um, Lisa, I was just looking that you did teach a basic investment concepts webinar for us a couple of years ago. So that webinar is up on the page as well if you're new to investing and you want to delve a little bit more than what was done in this particular webinar, the information is there as well.
Yeah, and Stacey, yeah, what do I'm running to? Because I know a lot of people are afraid to retire, because
Mm.
they're not. What are they running to? And I see people, and I'm like, gosh, I've got a whole list. My day has been planned. um, but my day, and but any other, yeah, it was great. It was really great. I appreciate Patricia. I appreciate the moderation. That was helpful. Like putting the links in and stuff.
Okay, any other questions before we sign off? Any other questions or comments? Okay. Yes, Holly. Benefits can guide you on your benefits retirement if you have questions about your leave time. So benefits@ufl.edu is the email that you can use. So if you have any questions about leave or retirement or anything like that, you can reach out to benefits with those questions. Okay, I don't see anything else. Any final thing you might want to add, Lisa, before we go?
I That's it. I mean, I hope, and I would appreciate, any comments to me, or I think you're going to send out an evaluation. So I love constructive criticism. Um,
Yep, as soon as the webinar ends, it will pop up automatically in your browser that you can complete it. And again, this webinar is being recorded and we'll upload it to our YouTube video. So if you missed the start of it, then you can go to our YouTube channel, I should say, and watch a recording of the webinar there.
and yeah, somebody said a question about the investment plan, about investment planning. We touched on it very briefly. There is a webinar, and also if you're talking about the FRS investment plan, FRS is a great. They've got lots of resources. Um, and yeah, and I think Patricia will direct folks to the YouTube channel. I know I googled it, and they've got some good stuff up there.
Yeah, there we go. I put a link to our YouTube channel in the chat as well.
Okay.
Okay, perfect. Well, thank you so much, Lisa. I appreciate it. And thank you everyone for your time today. Have
Take
a good
care.
day, y'all. Bye.